Well, hello, everyone, and welcome to the webinar today on how you can earn significant passive income by working with Alamo Mortgage Holdings. We offer a passive income bond for UK citizens for high net worth accredited investors, and we actually invest into purchasing American mortgage debt. In this presentation, I'm going to go through how all of that works. But before I start the presentation, first I need to have a disclaimer. And that disclaimer is that as accredited investors, you will be aware that all investments carry some level of risk. This investment is only available to investors who are able to assess their own appetite for risk. Please read the risk statement within the investment memorandum before investing. Okay, so fantastic. Our product is an 8% passive income mortgage note. We offer a bond, and the way that it works is you purchase the bond or the note, and then you earn 8%. You are paid biannually. Twice a year you receive a payment, and the term ranges from 3 to 50 years. The security is actually a debenture over our company and all the assets that our company has. We have a team that has 200 years of business experience working for you, with 100 years of experience in the mortgage industry in the state of Texas. So all of the collections of the payments, we handle that for you, where we collect the mortgage payments and then we make payments to you. We also can support you with multiple currencies. So if you prefer to invest in British pounds or US dollar or euro, whatever you want, we can support you in that. So we're very happy to work with our investors. Let me mention a couple of things. We've got a great team here at Alamo, as I said, with 200 years of experience. A little bit about my background. I have been in business for a lot of years. I've done real estate, commercial and residential real estate. I've done mortgage note investing. I also have been active in private equity and some different opportunities. So I bring a lot of business experience to the team. I also have had in-person training from the largest private note buyer in the United States. His name is Eddie Speed, and he has personally purchased over 50,000 mortgage notes. So Marina is a team member, Marina Zacharelska. She's our international investment coordinator, and she is so bright. She actually speaks 5 different languages. She speaks English, Italian, Spanish, Russian, and Ukrainian, her native language. She graduated with a Bachelor of Arts in International Relations from the EU Business School in Barcelona, and she likes to work with our investors to get to know them and to help with a plan to achieve the passive income they're looking for, help to design that plan. We have Scott Wynn. He's an industry expert for Alamo Mortgage Holdings. He has a lot of years of experience in the mortgage note industry. He's got 30 plus years experience repairing and selling houses, bulk real estate owned, non-performing note portfolio purchases. So he really brings everything to the team, and he's working hard for you here. We have Fred Hobbs, who is our Director of Mortgage Servicing. He's a licensed mortgage originator in the state of Texas since the year 2000. He's also the founder and president of Texas Mortgage Capital. From 2000 until 2010, he primarily originated owner-financed and primarily originated conventional and government-backed loans that were then sold into the secondary market. After 2010 in the United States, there were owner finance origination laws, and Fred and Texas Mortgage Capital, they focused on originating seller-financed residential private money mortgage notes all over Texas. So fantastic experience. And he has originated thousands of seller finance notes with private investors in both residential and commercial markets. So we're real lucky to have him with our team. We have David Jones, who is the in-house counsel. He's a licensed attorney in the state of Texas. He's a third-generation lawyer. He graduated from the Emory University School of Law, and he has been active. He's currently a member of the Texas Bar Association. He helps us with looking over the transactions, making sure that all of the legal paperwork is in proper order. We have Anna Kulikova. She's a specialist with investor relations. She actually speaks 3 languages, English, Russian, and Ukrainian, and she likes to work with our clients to help them obtain passive income. We have Mark DeRuyter. He's our Chief Technical Officer, and he has not only the background with a technology background, but he also has a significant background in the mortgage note industry, in the software. He also has been a mortgage note investor himself many years, but he has written for commercial use software programs that keep track of things like amortization schedules on loans, etc. So he's very skilled, and we're happy to have him as a team member. So here's how it works. You select what term do you want. You can choose from 3-year, 5-year, or 50-year. All of our bonds at this time, all of our notes at this time pay 8% across the board. Once a year, we make an adjustment, but if you select something this year, you can lock in 3 years at 8%, 5 years at 8%, or even 50 years. And then each year we do an annual review and we make a decision on what we're going to offer that year. So let's talk about why do so many UK investors still purchase gilts for passive income, and are UK gilts still worthwhile during periods of high inflation and a weakening British pound? This is so important. Now, let me go through this here. If you're looking to purchase gilts, let's say you're looking around and you've bumped into this video and you're looking to purchase gilts, you probably are in the situation where you want a reliable way to obtain passive income, and gilts would fit this requirement. The problem with gilts, though, is they are denominated in British pounds, and the pound has a decades-long history, a tradition of losing value against the US dollar. Another problem with purchasing gilts is that the returns they offer are lower than corporate income bonds. They're always lower. Interest on all registered gilts is payable gross without deduction of tax. Holders of gilts on the register maintained by CIS may opt to have tax deducted at source by applying to CIS. Gilts, of course, have their merits, and for an investor, this is important. Gilts have their merits, and for an investor that can turn a blind eye to the high rates of inflation. So if you're the type of investor that can see all that high inflation in the United Kingdom and you can just shut your eyes, turn a blind eye and say, I don't see it, that is one of the requirements. The second requirement is if you can also, with your other eye, turn a blind eye to the weakening British pound. If you can just ignore that for decades, your pound has lost value against the dollar. Ever since Bretton Woods, it's lost and weakened against the US dollar. Then if you're that type of investor, then yeah, you can accept gilts and you'll get paid on time and you'll get some passive income and it'll be great. And they're index linked and you can go to sleep and just, you turned a blind eye on both of the problems and hey, everything's good. Yet the fact that gilts are easier to purchase and more well-known does not mean you will earn as much interest. If you were to instead purchase my company, Alamo Mortgage Holdings, we offer a corporate income bond. If you were to purchase a corporate income bond through Alamo Mortgage Holdings, you could potentially earn hundreds of basis points more per year on your corporate income bonds than those old gilts. If you're interested in purchasing a bond, you can contact me directly by emailing ben.miller at alamomortgageholdings.co.uk or call me. I've got a US number, 1 for the United States, and then area code 817-203-4160. We can have a discussion about your passive income goals and also your investment goals. If after that discussion, the product seems suitable for your investment portfolio, You then can sign some paperwork that will be prepared based on the term of the bond you are looking for and some other features. If you currently have British pounds and you want to exchange for US dollars, that's easy to do. We simply handle the conversion for you, and then your bond is paid in dollars. At the point it is converted, you have made a dollar-denominated investment and no longer will potentially lose money on the exchange rate if the US dollar keeps rising against the British pound sterling. If you are in the situation where you have pounds and normally would want to purchase gilts, but you're looking at all this inflation and the pound endless. So that is so important, folks. It's something where if you're a UK citizen, you know, there's the issue of the exchange rate moving against you, where your British pounds are losing value against the US dollar and the high rates of inflation. So now let's talk about how Alamo Mortgage Holdings is here to offer a solution to you. First of all, we offer passive income where we can pay you 8% on your money. And we are able to do that by actually purchasing mortgage notes. We purchase mortgage notes at a discount. We purchase the mortgage notes at a discount. So we might find a mortgage note in the United States that has a balance of $100,000 that is bearing an interest rate of 10%. And I'll talk about why that interest rate is so high in another slide. But we would make an offer to purchase that mortgage note at perhaps $70,000. So we would say, well, you know, you've got a $100,000 note. We can give you $70,000 cash today. If you want to sell today, we can get you your money. And then that would be appealing to a certain type of seller. So, but the nice thing is when we execute that purchase, we are able to actually get the yield on the note up to 14.2% because the interest rate's 10%. But since we bought it at a discount, Alamo's earning 14.2%, which makes it quite easy for us to pay out 8% to our note and bond holders. Okay, let's talk about what determines the value of a mortgage note. So then what determines the value of mortgage debt? Because we know what determines the value of real estate. Real estate is determined by the value of a particular flat or house. It's determined by what are comparable houses and flats, what do they sell for? That determines the value. If it's a commercial property, it's determined differently, where it's determined by the cash flow on the commercial property. But for this example, if we talk about a mortgage note on, say, a property of maybe a residential home, there's six factors that determine the value of a mortgage note. The first factor is the buyer. So if you had a choice between buyers, say you have a property and you're trying to decide who to sell the property to, and you've got one person that is a government employee, and that government employee has a high salary, they've been working for many years for the government, maybe they work as a post office person, maybe they deliver packages for the post office, and they've been doing this for 10 years. If the government is their employer, you know there's a very high probability they're going to get paid on time. But if you have another buyer that says, you know, I'm 24 years old and I just started my new company and I'm just going to make a bunch of money with my company, and they don't have a regular income, but they have a plan where they're going to make money in the future, that sort of buyer is far less desirable. It's better to sell the asset to one that has a regular government income, the government employee, or the one that works at some sort of a big corporation. Maybe they work at Microsoft, maybe they work at Google, maybe they work at some big corporation. That buyer is more likely to be able to pay, where they are not going to have cash flow experiences where the things are up or down. The second thing that determines the value is the collateral. So the collateral means the actual asset. So Let's say that the property is worth 100,000. Say that's the market value. That's the real value, 100,000. But say that you had a seller that he sold the property with a note for 200,000. Pretend he found somebody who didn't know the prices, and that person agreed to pay 200,000, even though the market value is only 100,000. You have to treat that note differently, because the fact that he found somebody that signed a note and the asset's only worth 100, but he found someone that signed a note for 200 does not make the note worth 200. You could look at that note and you could base it on the value of the collateral. So that's a mistake, is a lot of times people don't look at the collateral, they just look at the value of the debt. And when they see the value of the debt, they may not have properly analyzed what's the collateral worth. The third factor that drives the value is the down payment, the money that the buyer initially paid. So let's say you had two buyers, one that put 30%, 40% of the purchase price, where if it was 100,000, maybe that buyer put down 30,000, 40,000, 30 or 40%. And then say another buyer said, you know what, I want to buy this. I'll pay you the 100,000, but I only have $1,000. I only can put down 1,000. Can you finance 99,000? And the seller agreed. So they both agreed to buy the asset for 100,000, but one of them put down 20,000. Another put down only 1,000. The one that put down the larger down payment is better, because there's less risk of the person saying, you know what, I don't want this. I'm just going to leave. I'm just going to move. I'm just going to, do, because he's got virtually nothing to lose. He lost $1,000, his down payment. But the one that put 20,000 or 30,000 down, he lost a lot more if he walks away from the deal. So that's why you look at the buyer's equity or their down payment or their upfront money. That's an indication of the value. So a buyer that puts down 10% is better than a buyer that puts down 1%. The fourth thing that's important is the actual interest rate. The interest rate on the note. So if you have a note, if you have a mortgage debt that pays 10% or 12%, that is better than a mortgage note that only pays 5% or 4%. So if you had a choice between two notes, two mortgage debts, and the first paid 5% and the second paid 10%, the one that paid 10% is better. The next factor that drives value is the history of the payments. So when you buy these mortgage debts, you want to look at how long has the person been making payments. You want to be careful buying a new note. You want to see a record of how long the person has been making payments. So if a person has a 30-year note, and they are 4 years into a 30-year note, where they still have 26 years left, that is safer if you see a record of payments compared to a 30-year note that the person put the down payment down, but they haven't yet made their first payment. Because what if the person just walks away? What if they don't make that payment? Then you've bought a note that is a non-performing note. You want to buy a performing note. A performing note is more valuable than a non-performing note, because then you don't have any work to do. You just buy the note, and the borrower makes payments to you. So a performing note is better, and the history of performance is important. The next factor that drives value, the sixth factor, is the actual paperwork, the legal paperwork, if it was done properly. Because if you have a note that was just two guys that were sitting around a kitchen table and they worked out a deal and they wrote it up without a lawyer, where they just wrote up an agreement and they signed it, that is less valuable because the note likely has mistakes. They're not lawyers. They just agreed that, yeah, I'll make payments to you for 30 years. Did they remember to put in any of the legal language? Did they know how to put any of the legal language in? These things are important. That type of note is less valuable than a note that had a proper closing at a legitimate company with legitimate lawyers that drafted the paperwork. Because you know that it's very likely that if you buy that note and the borrower doesn't make payments to you, you have legal recourse. You don't want to buy a note that hasn't been drafted properly, that doesn't have proper legal paperwork. So very important there. All right, excellent. That's real good. That's so important when buying a note to know about that. So here's an example transaction. This is not a property that's in our portfolio. This is not a mortgage note that's in our portfolio, but it's a great example transaction. It's a real property. This is located in Sweetwater, Texas. The sales price is $120,000. And we're going to imagine that a buyer put down $20,000 where they paid the seller $20,000. And then they signed a mortgage note for $100,000 where they're going to make payments over 30 years and they're going to pay a 10% rate of interest. So they're going to have a monthly payment of $877 per month. Now, let's talk about how this happens. What happens is somebody wants to buy the house, a seller puts it up for sale, seller lists it on the market. Seller doesn't get anyone that makes the offer that they want. They're fixated on getting 120,000 and they got an offer for 115 and they wouldn't take it. They got an offer for 110 and they wouldn't take it. They were set on getting 120,000, but now a buyer appears that says, hey, I'll pay you 120,000. Let me pay you 20,000 down and I'll pay you 100,000 over 30 years. I'll be happy to do that. And the seller says, no, you need to go to a bank. You need to get a mortgage. You need to go talk to my banker. My banker, John, is such a good banker. He'll get you a loan. Just go see him. He'll get you a loan easy. And then you can just pay me all cash with that mortgage. That's what I want. So the buyer went into the bank and talked to the seller's banker, and the seller's banker said, hey, you don't have a good work history. You're self-employed. We like to make loans to people that have stable, reliable income. We don't like to make loans to people that are self-employed. Oh, hey, you've got a bad credit score. We don't want to give you a loan. Get out of here. So the buyer left the bank and went back to the seller and said, listen, I tried. The bank said no. They said they wouldn't give me a loan because I'm self-employed and because my credit's not perfect, but I had a medical problem. And they talk about this, and the buyer says, let me just pay you the 20,000 and I'll make payments to you. I'll even pay interest. And the seller said, well, if I was going to let you do that, I wouldn't make you a loan at a low interest rate. I'd want to get a 10% rate. And the buyer said, hey, I'm fine with that. I'll be happy to pay you 10%. I'm paying rent now. I'd be happy to pay you 10%. So they agreed and they did the deal. Now imagine that 5 years has passed, and that because it's a mortgage note in the beginning, the first payments are mostly going to interest, not very much principal reduction is occurring. So imagine 60 months have passed and this particular buyer is doing a great job. They are making payments like clockwork. They are so reliable. So now the point is the buyer has made $877 per month in payment for 60 months, but the unpaid balance on that mortgage note is still $96,574. So very little has been going to pay down the principal. And now imagine that the buyer, the seller that owns that note needs to sell the note for whatever reason. They need cash. They want cash. They've gone through a life situation. They contact a company like Alamo Mortgage Holdings, our company, and they say, hey, we want to convert this note to cash. And then Alamo or some other company would say, yeah, we can buy that. We can buy that. We'll pay you. They'll negotiate whatever. But let's say that the highest they would pay is 12%. They might offer as high as $83,322. So you can see how this is very profitable. We're paying 8%, is very feasible. So that's basically the way that it works. Now, if you're from the UK, I would like you to think about your British pound. I think this is so important for UK investors because they think about, hey, I'm getting 8% already in the UK. What do I care about that? I already know how to get 8% in the UK. I don't need this thing. Well, folks, let's talk about Bretton Woods, and let's have you look at the history of your British pound if you're not already familiar with it. Many of you are familiar, but some of you may not be. So look at that, where basically once the exchange rate mechanism was developed towards the end of the World War II with the Bretton Woods Agreement back in 1945, one British pound would buy $4.03. And you can just see over the decades how the pound has lost to the dollar, the pound has lost to the dollar. The pound consistently over decades has lost a lot of value to the dollar, where now one British pound, instead of buying $4, it buys a little bit over $1. So this is why it's important to have some diversification in your currency, because if you have 100% of your portfolio in British pounds, and the British pound keeps losing against the US dollar, that is not such an ideal situation, even if you are getting 8%. So just think about that, folks. Let's take about why not do this on your own? That's a great question. Well, first of all, it takes some knowledge on how to do it. I'm not saying you can't do it on your own, but you're going to have to work at it. It's not as easy as it may seem. You have to learn what you're doing. You have to locate a motivated seller. You got to become familiar with the United States, all of this. So here's an example of what's good. When you invest with Alamo, you are investing into packages of mortgage notes. Here's an example of a real package of mortgage notes.
So this right here is actually an example of what a portfolio of loan notes might look like. So this is actually a real portfolio. And you look here and you can see the name of the borrower, the number of months. You can see the interest rate. This debt is actually pretty high, 14.75% is what they're paying on that mortgage. The monthly payment is $278.50. Then you can see the terms, the status, this sort of thing. So, I mean, you've got a list here, and this is an example of a package where a package of these mortgages can be purchased. This type of deal would be done by a larger investor. It would not typically be a single investor that would buy this package. For example, my company, Alamo Mortgage Holdings, this is the type of package that we might actually purchase, something like this. But if you're just starting out in investing, you might start out by you're just going to buy one mortgage note. So for example, you might come in and this mortgage note, if you find something like this out on the market, you might try to negotiate down from, the unpaid balance at $89,570. Maybe you try to buy it for $59,000 or $69,000. But that would be one note. But you can also purchase packages of notes. And that's something that Alamo Mortgage Holdings is involved with. It's a company that's a United Kingdom company that actually purchases packages of mortgage notes. So wanted to give you an idea of what a package of notes look like.
Fantastic. So that gives an idea of what a package of mortgage notes looks like. Now let's talk about why bonds. This is so important, because I sometimes get asked the question, with inflation so high, why should I buy bonds? Some investors, they're wondering about that. Well, that is a great question. Rather than giving my personal opinion, I'm going to talk about a Nobel Prize winning economist. His name is Harry Markowitz, and he actually won the 1990 Nobel Prize talking about how modern portfolio theory, which most of us are familiar with, this is the concept of diversification into different asset classes. So at any rate, Markowitz, though, when he did his own investing, he had a very simple method. And I'm not suggesting you handle your portfolio this way. I'm just suggesting you think about it. Because he won a 1990 Nobel Prize and he spent a lifetime studying. So let's see what he did. He would once a year make an adjustment to his portfolio where he'd put 50% in stocks and 50% in bonds. So he had all this going on, but once a year he just would do that investment. So if his stocks had gone up a great deal in value, he might acquire more bonds. And if the stocks had gone down a great deal in value, he might sell some bonds and buy more stocks, but he tended to average it out at about a 50% rate of return. And that way, his quote, was, and I'm going to read his exact quote. He said, "I visualized my grief if the stock market went way up and I wasn't in it, or if it went way down and I was completely in it. So I split my contributions 50-50 between stocks and bonds." Definitely something for you folks to think about. And Alamo Mortgage Holdings not only offers a bond, we offer currency diversification. So why secure our notes with Texas mortgage debt? Great question. Great question. First of all, Texas is a state that's winning. We've got people coming from California. We've got people moving from New York, from California, because they like Texas. Texas has a lot of advantages. The pricing of housing is much lower. There's a lot of good opportunities for employment. Your money goes a lot further in Texas than it does in New York City. So this is something that attracts a lot of people from cities like Los Angeles or from New York City, where they want to come to maybe Austin, Texas. They want to go somewhere where they can enjoy their money, where they can get more. And as a result of that, when they move into Texas, when those people move in, it drives up the value of our Texas real estate. And that is a good thing for Alamo and a great thing for our Alamo bondholders, because we are purchasing mortgages that are backed by, secured by Texas real estate. So the value of our collateral is increasing. So it's a wonderful thing. What are some of the advantages and key features of the bond? First, you can reach your passive income goals more quickly. Whatever you're looking for, we can help you reach your passive income goals more quickly. We also offer maximum diversification. So you're not just investing in one mortgage note, you're investing into a package. Another thing is we don't charge our investors any fees. Now, some of you that may have heard the private equity and the hedge fund guys talk, they talk about 2 and 20, and they've got their fees down to a science. I'm not giving those guys a hard time. I'm not saying they don't deserve their fees. I'm just saying that 1/3 of private equity, they fail. 1/3 break even, and the remaining third actually make money. So it may look great when you look at that brochure about how much money that private equity deal is going to make, but you just should be aware that 2/3 of them don't make money. Just something to think about. Whereas with this, it may not sound glamorous, 8%, but it's a lot better to get an 8% return than to suffer a loss on a private equity deal. Most people would agree with that. We also offer interest payment flexibility. So it's so simple. You invest £100,000 and you can earn £8,000 a year in interest. If you put the money with us for 5 years, if you buy a 5-year bond or note, you're going to get £40,000 in interest, and you're going to get your £100,000 in principal back. Or if you were to do the 50-year term, you'd earn £400,000 in interest and £100,000 in principal back. Why should I invest in that's a great question. If you are looking for an above average rate of return, this is a product that can help you with that. If you want to just be average, you don't need this. You could just buy a gilt. How long is the note? Well, the note ranges from 3 to 50 years. Can you put the note into your sipp, your self-invested personal pension? Well, that is actually a question that your sipp provider needs to answer. However, if you talk to your sipp provider, if you show them this presentation and they don't understand what we're doing and they try to tell you something like you can't do it, call us back, because we know a lot of other sipp providers and we can put you in contact with one that understands our financial product, or we can work with your current sipp provider where we can talk with them more. And I can't see any reason that it wouldn't be suitable for a sipp, but only your sipp provider can answer that. Is it a regulated product? No, this is not a regulated product. That is part of the reason that we can pay such a higher rate of return. Getting a product regulated is a tremendously expensive process, and that money has to be recouped, and that results in lower rates of return. With this is a product that is based on hard collateral. Hard collateral. Anyone can invest. Anyone can invest that's a certified high net worth accredited investor. You've got to be over 18. And folks, just judging from the people that are here, the good news is I think everyone qualifies as being over 18. So you also could have a trust, a company, a charity. Come one, come all. We welcome you. How's the money protected? Well, we protect the money by using collateral. So these are collateral-based loans, and we secure the money that way. So very good. How's the tax managed? We pay all the money to you. We pay 100% of the interest to you, and then you can decide how much in taxes you should pay with your tax professional based on your marginal tax rate and based on what country you're in. Are there any limits on how much you can invest? There is no upper limit. We welcome larger investments. We suggest a minimum of 100,000 pounds, but if you're just getting started with us, if you want to, do something smaller the first few years, that's fine. We can work with you. We're happy to have you. Can you get access to the money early? No, folks. This is not like day trading where you can, this is not like you go to your brokerage and, the stock went down, I'm going to sell it at a loss. I don't, you can't do that here, folks. This is something where it's a longer term thing. But listen, that day trading, moving in and out, it doesn't do anyone any good hardly. If you look at the studies, the people that do that day trading, they lose a lot more money than the people that just make an investment and let the money work for them. And that's what you can do here with Alamo. So if you want to invest, just send me an email, ben.miller@alamomortgageholdings.co.uk, or call me +1 817 203 4160, or go to our website and fill out the contact form. Folks, I really enjoyed doing the presentation. I'm going to stop now, and I'm going to stop the recording, and then I'm going to open it up for any questions. But I'm glad to have everyone here, and thank you so much. I look forward to answering all of your questions, and thank you for coming to the presentation today. We have these every week, every Thursday at 1 o'clock UK time. Thank you, and have a beautiful day.